Hey everyone, welcome back. I'm Jeremy Szafron. As we kick off the week, the story on Wall Street is one of resilient strength. Despite calls for a break, the S&P 500 saw a small gain today, holding near record highs after a $15 trillion rally from its April lows. Major banks like Goldman Sachs are even boosting their year-end target, citing historical strength during rate cut cycles from the Fed. But the most dramatic action is in hard assets. This morning, gold is establishing a new range in record territory, trading firmly in the low $3,700. I think almost $3,750 on the spot side. And silver, it's also been the real story, breaking out of its 14-year high, pushing into $44. And that range in the move has captured the market's attention. Now, meanwhile, the ultimate leverage play to the metals theme, the mining sector, well, as you can imagine, it's on fire as well. The gold miners index has now surged over 50% this year, and we're seeing major moves in individuals like Barrick just this morning on news of a potential game-changing U.S. gold project. Now, to make sense of what these powerful signals mean for the months ahead, we're joined by founder and CEO of Merk Investments, Axel Merk. His firm has $2.5 billion invested in the gold miners. Although, Axel, with this price action, I think you're maybe worth a little bit more on that fund. Good to see you.
Good to see you. Yes, just to give you a sign of where we are, we currently manage a little over 2.9 billion, and we had less than half than that under management 12 months ago.
Wow. So you're obviously, full into diligence mode here, looking at where to catch a bid. I want to get into miners, but before we do that, let's talk a little bit about this divergence in risk assets. I mean, let's start right there with silver. We're seeing this major breakout to a 14-year high, pushing it to $44. I mean, we'll see. This is the time of taping anyhow. And for years, the market has discussed a persistent structural supply deficit in physical silvers. And I'm wondering if this powerful price action is the first sign that this physical reality is finally kind of overwhelming the paper markets and inserting itself in the price discovery mechanism, or is it something else?
I think, as any silver investor knows, investing in silver is one of the more gut-wrenching experiences. So you have to take any good news as you can. And part of the reason is that on the one hand, it behaves like gold. It has the characteristics of a monetary metal, but then it has the industrial component. And so whenever there's a perception that the economy plunges, silver is a headwind. And on a day where we're talking, it is not too surprising that the S&P is also higher as silver is breaking out further to the upside. And I think that's a sign that we have both a Fed that's easing, and at least for today, the glass is half full with regard to a relative perception of economic growth. But that's part of the reason you have this much higher volatility in silver, because it just every day wants to decide something different as to where price action ought to be.
Yeah, no, it's been, obviously we know it's notoriously volatile, and its last major peak was in 1980. How do we know that this isn't another speculative kind of fever that could quickly reverse, especially given its strong correlation to the industrial economy, which the Fed itself sees as weakening?
Well, clearly, gold miners, silver, it's all somewhat in the speculative category. By the way, the price of silver historically has a volatility of the S&P 500 with bursts to the upside, but silver obviously more volatile than that. How do we know? Well, of course, we don't have a crystal ball. What we do know is that a lot of the speculative money in recent years had moved over to the meme stocks, to digital assets. And in recent weeks, we have seen some of that come back in the sense that digital assets, especially as we're talking today, are under pressure. How long these trends move, that's very, very difficult to say. The speculator is not a loyal investor. In my assessment, we're in the early innings of that. What it means for practical purposes is that volatility will remain elevated if it's not going to get more elevated. And so calling the top, though, to the extent that speculators would take over, and I don't think they've taken over, but they have an influence, is extraordinarily difficult. And I'm not even going to try to do that.
Yeah, we're not doing a Bitcoin segment today, but I did have you on back in April, and you were talking about, it kind of maturing. And in contrast to the strength that we're seeing in tangible assets, obviously there's a different dynamic in the digital asset space. We see Bitcoin kind of holding its own here, while a wave of leverage washed out that Ethereum and kind of the altcoin markets. What does this split tell you about how sophisticated capital is assessing risk right now?
Well, in some ways, it's good news. And last time, I think I said Bitcoin still wants to decide what it wants to be when it grows up. And the reference was that crypto assets are highly correlated with risk assets. And the gold, of course, has a proven track record of being uncorrelated, although with gold, it's phasing in and out. And today, of course, the crypto investor will prefer to go to the upside. That the fact that it's moving in the opposite direction, I think, is actually a healthy sign. There may well have been too much speculation in the short term. I hear there's some liquidation and whatnot, and so those are signs of a healthy market. Obviously, this quote unquote healthy market can turn into gut wrenching if it goes down too much for some investors.
Yeah, you're not kidding there. Everyone watching tightly trying to kind of decipher it. I want to get to gold, but before we do that, let's connect these market moves to the policies that are obviously fueling them. I mean, I want to talk about the Fed because this morning we're seeing a remarkable public debate among Fed officials. On one hand, you got St. Louis Fed President Mussolini. He's saying that there's limited room for cuts. But then on the other end, you got Fed Governor Stephen Miran just gave a speech with Bloomberg arguing the policy is, quote, well into restrictive territory, and that he dissented last week because he wanted a half-point cut, not a quarter point. What does this open division at the Fed tell you about the certainty of the path forward?
Well, first of all, Powell himself has said it would be abnormal not to have disagreements because we do have, on the one hand, inflationary pressures that persist. On the other hand, we have an economy that's slowing and, according to various sources, presumably weakening more precipitously than previously anticipated. I am not a fan at all of Fed officials telling the public what they will do. It provides a mental actor to them that ought to react to data. Now, obviously, you can have the view that we should have cut more. That's all fair, but there are several coming out saying, "Oh, I will have one cut this year, 2 cuts this year." That is not how monetary policy is supposed to work. That's a crisis tool where you try to manipulate the yield curve. They're supposed to say, hey, we go into the room and then decide. Now, the quote-unquote good news may be that the monetary policy is less relevant. There is such draconian action happening on the fiscal side in various directions, be that tariffs, be that other measures, that seems to have kind of sucked the air out of the room. For the Fed, it's more long-term, whether that so-called independence will be preserved. And for that, what I'm looking at is who the next Fed chair will be, and whether that's a person of substance who can independently pursue a new agenda and potentially reform the Fed as well.
Any guess on who that might be, or is what I'm kind of hearing from you in layman terms, Axel, is we're almost seeing some live televised job,
For those,
is that what's happening?
For those calling for a Fed cut, yes. So if you want to reform the Fed in earnest, Kevin Warsh is the person to have. He is somebody who, before all this became a political hot potato, was calling for reform at the Fed. He says when you've gone off track, you gotta go back to basics. He is in the camp that the Federal Reserve is doing too much. I don't like political interference in the Fed because it makes monetary policy less effective and more expensive. But the way to fix it is to get out of politics at the Fed. When you buy mortgage-backed securities, you're allocating money to a specific sector of the economy. That is fiscal policy. When obviously pandemic and various financial crisis actions are fiscal policy, not monetary policy. So it is not surprising that there's more interference. And so if you want to have somebody who understands it and actually structure left changes that are within the given law, Kevin Warsh is the person. Just as a reminder, we just had this 5-year review by Jeremy Powell, and it was your typical lame duck review. They basically didn't change anything, didn't admit anything has gone wrong in recent years, and it's not surprising that there's political interference, as little as I like it.
Yeah, interesting. I mean, some would say that a hawk like Warsh seems to kind of be the exact opposite of what President Trump has been demanding from the Fed. Do you think an appointment like that would create even more public conflict between, the Federal Reserve and the White House, leading to more volatility, not less?
Well, any Fed chair is going to pursue a policy that they deem right.
Yeah.
And Kevin Warsh has called for easier policy. What Kevin Warsh has also done, also before it became a political hot potato, he has said that the data that the Fed is looking at is really bad. This was before the jobs numbers were discredited and whatnot. And what he's pointed out is that we need to look more at real-time data. Keep in mind, right, we used to have real-time data. The Federal Reserve looked at the yield curve and got information back. The Federal Reserve used to intervene in the markets to set the federal funds rate and see any issues flaring up with any particular banks in that process. We don't have any of that anymore. And as a result, the Fed officials are reading the tea leaves, they're debating club, and are bound to be late. And so what you need is you need some, and of course the communication strategy on top of that has substantial shortcomings these days. You need somebody who appreciates those sort of things. And in my book, Kevin Warsh is the guy to do it. Then there's a bunch of people who will do the status quo. That's a likely scenario. And then, of course, you could go the other direction where you have somebody who is doing exactly what the administration wants. That would be very negative because it would increase long-term borrowing costs. By all means, President Trump has every right to have an opinion. But when somebody influential torpedoes monetary policy credibly, when it's more than just regular politics which every president has done, maybe Trump more than others, it means that the Fed chair can't just move the markets with a few words. It will be more expensive to move the markets, and that just raises the cost of borrowing for everybody.
Right. And then at the same time, the price of geopolitical safety is also being repriced. I mean, in Europe, France is now being called the new poster child of fiscal woe. I mean, suffering its second sovereign downgrade in just a week, just as Italy earns an upgrade. For a central bank or a large institution looking for stability, what does it signal when a core European economy like France is seen as a rising fiscal risk?
Well, the central bankers will just always focus on the problem of the day. The problem in Europe is that you have a Draghi-style central bank. It's Madame Lagarde now that will do whatever it takes. That's really the curse of central banking. They want to be independent, but ultimately that independence is not possible if fiscal policy is not in order. So on the one hand, everybody, quote unquote, wants France to get its pension system under reform, to get its budget deficit under reform. At the same time, Madame Lagarde at the most recent ECB meeting confirmed that the quote unquote transmission mechanism will be monitored closely. That is not Fed speak, but ECB speak for saying they will buy French bonds if those bonds were to blow out, which again means that the market cannot exert pressure on politicians. And if there's one thing that we have learned from Greece and other countries, that policymakers will only make the tough choices when the market forces them to do so. And if the market will not make the tough choices because of central bank intervention, then we're not going to get any reform. And that's I think that's the baseline. It's one of the reasons why precious metals are doing well, because views that used to be fringe views are moving more towards the mainstream. And while not everybody is embracing them, because the market is comparatively small, that gradual change has an impact. And if I can make one more point, is that one big change that has happened in recent months is, and I think I mentioned this on your program, I believe that tariffs don't just impede the flow of goods, they have an impact on financial flows. Deficits will have to be financed more domestically as trade is disrupted. And that, in the absence of fiscal reform, exerts increasing pressure on monetary policy, which is exactly what we have been seeing.
Yeah, interesting. And I mean, on the euro front, Axel, I mean, does this kind of fiscal divergence where a core country like France is weakening prove that the euro can never be a true kind of independent competitor to the US dollar because of it lacks its single kind of unified fiscal backbone?
Well, there's only one US dollar, but that doesn't mean, we can criticize something about every country. That doesn't mean that currency can't rise or fall. Keep in mind that Europe is on an extraordinary spending spree where they want to spend hundreds of billions on, in Germany's case, 500 billion euros on defense, plus 500 billion euros on infrastructure. One thing I'd like to point out that year to date, the Swedish currency is actually the best performer. And Sweden, fun fact here, is the one country that, as a percentage of GDP, has the highest defense spending. And so Europe needs to spend more on defense, and that spending provides economic growth. Of course, it can also provide inflation. The other thing in Europe is that, as far as the eye can see, nobody expects any changes in interest rates, whereas in the US, there's an expectations of more rate cuts coming up.
Yeah, well said. And we'll bring up Sweden here in a few minutes, because we're going to get to the potential looming October 1st breakdown of kind of what's happening in Washington too. But I want to get to the producers, because obviously this all leads us to them. I mean, given your firm's significant position in this area, I kind of want to do a deep dive. I mean, with the miners index up over 50% this year and some of these major banks calling for much higher gold prices, are we witnessing the beginning of the single greatest margin expansion opportunity for the sector in a generation?
Yes, I think it's the short answer. No, I can't give any investment advice here. Clearly, the market has valued the gold in the ground less so than it has in the past, because even though these miners have gone up quite substantially compared to what's in the ground, I would think there's more upside potential. Now, there are many reasons maybe why the market has been reluctant. One is, there might be, some people may think that these prices are not sustainable, but more importantly, investors have just been burned too many times. In the past, when the price of gold has gone up, there has been the price of oil has gone up, and about up to a quarter of the cost of mining is energy. Workers want to have higher salaries. Governments want higher taxes. But in the current environment, those cost pressures have been comparatively benign. And so, yes, there will be margin expansion. Although on the major producers, because they have the balance sheet in order, they have less leverage than they used to have, which of course doesn't change the fact that many of the juniors have tremendous leverage, and they have been struggling to keep up. I mean, I'm chuckling here because of course they have done very well, but historically speaking, money first goes into the major producers, and then with an amplified impact in the more junior miners. Again, because there's a speculative space, I can't just tell people to put money into it. But if history is any guide, I would not be surprised at all if that were the case.
Yeah, it's interesting. I mean, when we talk about the majors, while the rising gold price is obviously, a clear tailwind, miners also face these rising input costs for labor, steel, energy, as we kind of know. When we talk about these elevated inflation, rates in the U.S., and we talk about getting to 2, and it's not. I mean, how much of a risk is there that this inflation in the real economy could eat away at those producer margins, making maybe the expansion less dramatic?
Well, a little bit, of course, will be there, but we do have a Federal Reserve who has clearly put its emphasis on the jobs market now, and is downplaying the inflation risks. The labor shortages are not that significant compared to how they've been in the past, and similarly on the machinery input. I mean, we talk about tariffs all the time, but a lot of the gold mining doesn't happen in the U.S., so these tariffs matter much less than they would otherwise matter. And so, yes, there will be cost pressures, but nothing, at least currently, I don't see it compared to what we've seen in some of these other cycles. Clearly need to keep an eye on it, clearly need to see how sustainable it is. And of course, the funding window is quite open these days, so we'll have to see what discipline are there in the deals. But while there is optimism and we've seen more retail participation, I think the institutional participation is still modest. Right. Evaluations in these merger activities are still quite disciplined. And so it's impossible to say whether that window is going to be a few weeks or a few years. Right. And it's for the time being, I'm very comfortable with where we are.
Yeah, the margins have been incredible to watch, and most have been, simply trying to increase them. I mean, there seems to be a strategic split developing. We have majors like Agnico Eagle. Obviously, they're emphasizing discipline, while junior explorers report spectacular high-grade drill results. I mean, as an investor, you just kind of talked to us a little bit about it, but how do you balance the safety of a cash-flowing major against the explosive potential of some of these junior explorers?
Well, we've always tried to focus on opportunities where there is more than just a potential margin expansion because of a higher gold price. So we like
Hmm.
to invest in the more junior developers that, as they get added to indices, for example, there's more investors are coming in. There's going to be a margin expansion or multiple expansion and so forth, so that one isn't just dependent on the higher price of gold. But of course, there are various ways you can make money in this
Yeah.
segment, and and even I don't want to talk too specifics about the miners, but some of them have had some issues and they are behind them, and so no wonder that the market is playing catch up with them. It's also not surprising that is as interest is broadening, that the majors are prime beneficiary for the time being, right? And so for now, this market is behaving, even though we've had extraordinary returns, somewhat as one would expect. And if anything, because the price of gold has been high and getting even higher as we speak, right? These are very rational moves. Now, does it mean the one thing I'd need to point out is, of course, when you have such high upside volatility,
Hmm.
we know that volatility can work on the downside as well. And why I'm not concerned about it at this moment, any investor needs to be aware that is, of course, absolutely possible.
Yeah, well said. And of course, we're not going to ask you for the stock picks. We know we can't ask you for it, but I do want to talk a little bit about the majors because we're seeing shares of Barrick surge on the news of this new potential game changer project in the U.S. I mean, how important is it for the major producers to not only show capital discipline, but also to actively develop and de-risk major new assets in safe jurisdictions like the United States?
Hesitating because you put a lot in this. First of all, you say safe jurisdiction in the U.S. The U.S. has as much geopolitical risk as any other, not as any other jurisdiction, but there is political risk. Clearly, with the current administration, if you're on federal land, gold was elevated to be a strategic mineral, and the the permitting and so forth is greatly eased. So that is a very a positive tailwind. Um, the other part of the reason why I was hesitating responding, the majors have underinvested, and
Hmm.
there isn't enough there aren't enough discoveries of size for them to catch up. And it's part of the reason why some of them have gotten involved in these huge copper gold projects. That doesn't mean they can't execute, but it changes the risk profile of these companies. And they can't just gobble up all kinds of small miners. They've clearly decided on a different path forward because they they can't gobble up enough. And so that's why the opportunities, I think, in the majors and in the more junior space are going to be quite distinct going forward. Keep in mind, of course, that the ETFs cannot easily handpick securities, right?
Hmm.
And the active management in the space is still very limited, which on the positive side provides tremendous opportunities for the active manager. And the one thing maybe I should add is the gold mining sector has the greatest dispersion of returns of any S&P sector, meaning the returns are all over the place. Active management matters much more
Right.
so, and you're dealing with a rapidly depleting asset.
Yeah, that's a good piece of advice. I mean, with gold at record highs, a skeptic would say that this, newfound capital discipline is actually a sign of weakness, that the majors are struggling to find quality large-scale deposits to replace their reserves and kind of choosing, buybacks and dividends instead by their default. I mean, are the producers at risk of shrinking their production profiles in this bull market?
Well, yes, that is a risk. They will always do what investors push them to do, and for years they told them to get their balance sheet in order, and so they did.
Yeah.
But of course,
Yeah.
the flip side of that is that there's less leverage in their balance sheet, and so investors have to pick and choose kind of their what they want to do. Clearly, when there's an extended bull market, everybody would like them to be more levered. And so we'll just have to see how the companies react. I mean, the good news is that when you decide on a project, you're not going to assume current gold prices. You're going to go with far lower gold prices. One of the questions we asked them at conferences, like, what price do you get in? And if they get too far ahead, then that's a concern. But if you budget at a much lower price, which you have to do for operational reasons, then of course it's fantastic when the price of gold goes higher. But the folks digging the gold out of the ground, most of them are good at digging. They are not necessarily gold bugs, right? And so it's the operational technology that they worry about, and so they should, right? And a higher gold price is fantastic for them, but they will make the operations work even at a much lower price of gold.
Yeah, you made the point there that, these large institutions are still significantly underinvested in the mining sector. What do you believe is the key catalyst that will kind of force them into start allocating serious capital to this space? Is it a sustained period of gold over a certain price, or a significant and prolonged downturn in the general equities?
I think that's exactly it, right? I mean, there's nothing that attracts gold investors like a rising gold price, and investors are scrambling to get more gold exposure should the S&P perform poorly. In the initial downdraft, should there be a severe market correction, everything may go down in quotes, but then the Federal Reserve would react, and then miners tend to recover and go up much more, at least if history is any guide, right? And so it's that sort of environment. There are, of course, different types of investors. They invest for different reasons, but investors concerned about valuation and looking for diversification, that's a big part of it. And so given that the equity markets continue to be elevated, there is plenty of more opportunity for people to be concerned about valuation, and especially should we indeed have a bear market in stocks, especially a more severe one, that might also help the minus. That's not a forecast for today or tomorrow, but just something to keep in mind.
Totally. I mean, as you watch your own fund, obviously this price action, there's been some significant jumps. Are you worried that the price of gold's going too fast, too soon? Are you happy with a little breather here? What's your thoughts?
I've been in this business for too long to get too emotional about these price moves. Obviously, one feels better when the portfolio is up. And as we're trying to do on these conversations, right? There is a price action, then we're doing a macro overlay on top of it. Obviously, it's not our macro talk that will move the markets. It is the supply and the demand, and we're trying to understand of what is driving it. To me, those decisions we are seeing here are very rational. Now, I might be biased, right? I mean, when your business is dependent on gold and gold mining, I might be biased. So I try to listen to the input of others. What I do see is that a lot more asset allocators outside of the gold space, historically outside of the gold space, are pointing to gold as one of the few things that they might want to add to their portfolio as quote unquote insurance. Again, right, this is not a safe bet to be in that space, but as the views are broadening that something is amiss structurally on the fiscal side, which something that, of course, your audience has heard forever, but is making it more to the quote-unquote mainstream, I do think that there continues to be significant upside potential.
Yeah, interesting. Okay, well, let's pull the lens back a little bit and look at the road ahead. I mean, I want to bring in fiscal policy, as you kind of suggested. You and I were chatting this morning, and in the U.S., we know Congress is once again facing a standoff over government funding with an October 1st deadline, just days away now, Axel. I mean, this seems very, kind of stark contrast to what's happening in Europe, where we're seeing these major spending initiatives on infrastructure and defense. And you just brought up that Swedish krona. I mean, it's the best performing G10 currency. And I think you were talking a little bit about how you highlighted this morning how it's tied to that country's defense spending. I mean, the bigger question is how do you analyze the investment landscape when you compare U.S. fiscal paralysis with Europe's proactive fiscal stimulus?
Well, all else equal, paralysis would mean less fiscal spending. If we get a shutdown, Rand Paul, I think, phrased it appropriately. The way you get a compromise is the Republicans get a little bit more defense spending, and the Democrats are getting a little bit more assurances on entitlement spending. And so you end up spending more when you have these compromises. All of this is really noise because the big entitlement spending issues are driving the expenses. But yes, net, we are fiscally expansionary in Europe, whereas we at least have had attempts with Doge and similar to contain some of the spending. So at least the expansion of the spending in the US is less than it had been, and potentially less than in some other places, notably Europe as well, that really wants to spend more on defense and infrastructure. And so the way I look at it is that we live in a world where politicians need to make promises to get reelected. We have a rise of populism in many parts of the world, which also means more spending. We have the cost of doing business going up, be that because the U.S. can't be the securing the seas globally anymore, be that because of tariffs or other geopolitical events. We have the climate change, and you may think of it what you want, but it will increase the cost of doing business in the medium term. So these are, and then we have demographics, of course, that that just exacerbate many of these trends with regard to the fiscal obligations. And so when you look at it all, you say, well, why don't you hold some rules, right? As a quote unquote insurance, that doesn't mean the equity markets can't go higher in that sort of environment, especially when you have enough of a deregulatory push. By all means, there are some areas that could benefit. But I think the one thing that's assured is that our politicians will globally will not come to the senses and favor fiscal discipline, especially if you're going to face another election at some point in your future.
You know, this combination of easy money and these fiscal questions has some drawing historical parallels. The Wall Street Journal recently featured this cover story. I don't know if you saw it. They were discussing the potential for a blowout market rise, followed by this 1929 style crash. I mean, you've suggested that to understand this, we need to look a little bit deeper, specifically at the policies of President Coolidge and Hoover. So walk us through this historical parallel and what it tells us about the current situation.
Yeah, so first I'd like to mention, in the late 90s, Greenspan warned about irrational exuberance, but it took years for the market to have a top. So timing this is very difficult. If we contrast today's environment with 1920s, there are many, many differences. President Coolidge was kind of somebody who was a government minimalist. He wanted the government to be out of anything and everything, including not even helping when there was a national disaster, is one of the reasons why Hoover became president, because this was just a time when radio became national. And so anybody's plight locally became national news. And Hoover was a hands-on person who helped organize some of the help in national disasters. What he had done is, as he was elected, he had made some election promises, including some on tariffs, and being a man of his words, he followed through with them, and that exacerbated then the downturn. There's some other key differences. One of them I'd like to highlight, when during the time when Hoover was rising in influence, it was President Hoover, and even before he was president, who was really at the dawn of the public believing in experts. He believed you need to have national economic data, you need a national data on health in order for government to do the right thing to help the economy. We've gone full circle, and now experts are the bad guys. This was also the 1930s. We had the expansion of the administrative state, and we are in that in reverse. So while there are parallels, we're really coming full circle here. The context in both places is, of course, that valuations are very high. And if a wrench is thrown into that, through whatever means it may be, we might know what wrench it's going to be in or not, that can cause a severe correction, of course, at some point.
Interesting. So given those key differences, specifically the Fed's ability to intervene aggressively, does that mean then, Axel, I mean, the primary risk for investors is kind of changed here? Are we now in an environment where we're less likely to see a sudden deflationary crash like 29 and more likely to see this slow, grinding decline? What are your thoughts?
We had more reliance on gold back then as well, whereas now we have a micromanagement of the economy. I like to remind people, banks mismanaged interest rate risk, and the Fed all but bailed them out. There's a reason we haven't had this recession. The Federal Reserve believes, and if you read Bernanke's book that he wrote during the pandemic, he firmly believes that it's the Fed's job to ever more micromanage the economy. And that will, of course, that creates this put option that gets asset prices to be ever higher. Of course, that doesn't mean they always go higher, because at some point the market may have enough and they'll go in reverse. That said, we know that the reaction of the Federal Reserve will be to again foam the markets. And so it is not surprising to me that the price of gold is moving higher, and that if the solution to everything and anything is easier policy.
Yeah, yeah. I mean, Morgan Stanley's strategists are floating run it hot scenario for 2026, where the Fed cuts into a strong economy, potentially causing earnings to come in much stronger than expected. Is that a plausible outcome in your view, or is that policy path that risks unanchoring inflation expectations entirely?
Well, yes and yes. I mean, we keep in mind we have a midterm election coming up. That means we need boost to economic growth ahead of the midterm election. And so while we had a lot of headwind with Freedom Liberation Day and whatnot, we will have a greater emphasis of things that are presumably providing a tailwind for the economy. And so the quote unquote run it hot scenario is a scenario. There's so many different options that I don't want to say that this is the most likely one. I happen to think that there are plenty of indicators why the economy is slowing down. Usually, if there's just one or two of them, it might be okay. But if you have both Europe and China slowing down, for example, then it would cause a recession in the US. Europe is going to be very expansionary. China also wants to keep its economy going. So a growth scenario is certainly possible. As a gold investor, I'm looking at where we are in kind of this economic cycle, and we are in an easing cycle. And unless inflation really whacks us, that's a technical term, I think that the Fed will continue on its course. They might end up moving slower than expected, but keep in mind, it doesn't matter what the Fed will do. What matters to markets what might happen. So if there's anticipation that the Fed will continue to be an easing path, that's good news. Just as when we were in the higher for longer environment, junior miners in particular had depressed valuations because funding conditions were tight, because it was intentionally, the credit conditions were intentionally tightened. We are far away from that, and it's one of the reasons why the miners are doing well as well.
Let's tie this all together before I let you go. Kind of for the investor, I mean, given everything we've discussed, the Fed's actions, this fiscal imbalance, and the repricing in hard assets, has the very definition of value changed here, Axel? I mean, are traditional metrics like PE ratios taking kind of a back seat to things like tangible assets and, resource scarcity, things like that?
Well, the difficult part about assigning a PE ratio to the miners that don't produce is that there is no earnings. And so what we do is we invest more so than in earnings. We invest in management teams, the scarcest resource in the mining sector and many other sectors. And if we look at the potential of these, with the current price of gold, the potential is tremendous. Now, that said, of course, there are plenty of aspects in the equity markets where you have PE multiples, and yes, many of them are stretched, right? And so if there is value, yes, it's scary to say, but I happen to think there's better value in many miners, even though they have risen quite dramatically than in many other places. Again, when I say these things, I do have to add the caveat that this volatility is for the speculator only here, or to be consumed in small bites. Now, for full disclosure, I have fairly substantial exposure to that sector. It's about the risk you can afford, and yet that you're able to manage.
Yeah, well said. You don't want to be holding the bag. We try and advise everybody on that one here as well, especially in this market. I mean, is it just metals and miners? Is there any specific sectors or themes that you believe that maybe the market's overlooking before I let you go?
Well, on the mining side, right, the developers in particular, the more junior side has kept up. But there is, in my view, much more potential for them to just do what they historically have done. Now, of course, it doesn't need to play out that way. So I do need to throw that out. Otherwise in the markets, right, what people forget is that the way to think about diversification is during good times. In 2008, a lot of people lost a lot of money when things came crashing down because they were riding the wave too much. It ultimately depends on anybody's investment process. But what I'd like to encourage people is have a process. And what I'd like to add is it doesn't need to be a good one, but if you don't have one at all, then you're almost certain to lose money.
Yeah. Don't just go in buying it all. All right, Axel Merk of Merk Investments. Thanks for your sharp and essential analysis of the landscape here, my friend. I appreciate your time.
My pleasure.
A historic repricing of assets is clearly underway here, from the breakout in silver to the powerful moves in the mining sector. Of course, we'll be tracking all of these developments right here at Kitco News. And if this is the kind of in-depth analysis and you want to stay ahead of these market-defining moves, make sure to hit like the video and subscribe right here to the Kitco News channel. Let us know your biggest takeaway from Axel in the comments section below. I'm Jeremy Szafron. Thanks for watching. We'll see you next time.